Hello, silver bugs and silver bulls. Today's special commentary is going to be on the prices for silver for June 7, 2013. And I believe, my opinion, that we are approaching a near-term bottom in silver prices. Now, yep, I said it, a near-term bottom. Okay, now before I go ahead and talk about predictions, let's talk about trends and where silver's heading. I want to talk about why gold and silver prices increase in price. Now, most people believe that prices increase because magically there is a run on silver, there is an economic collapse or something like that, but in reality it's much, much simpler than that. Alright, now if you look at silver prices and gold in general, and you ask the question, what makes prices go up? What makes prices go down? What you're going to find is that it's really broken up into four categories, so to speak. The first one is, on the demand side, whenever there's talk about an economic collapse, dollar collapse, the economy is going to shit, pardon my French, but anything of that sort, any doom and gloom, precious metals will usually go up. Now, I'll say usually because there are some circumstances where that rule doesn't apply. If we don't have that fear, then we don't have a rise in prices. Just pure and simple. So you have to basically bet against the world. Alright, so not too good, right? The second thing is monetary policy. And what I'm really talking about is the almighty interest rates set by the Federal Reserve. And not only that, but federal central banks across the globe which set interest rates at a certain level. Now, for some reason, and maybe you guys can help me, enlighten me a little bit, everybody follows the United States. Nobody really cares about the central banks in yen and in Japan and Europe and whatnot. Now, we talk about it, but the markets are really driven by the U.S. Federal Reserve for some odd reason. The third one is gold and silver are considered to be what we'll call alternative investments. Now, what I mean by that is that if you have stock and it's going down the toilet, you have bonds which is also going down the toilet, where else can you put your money in? Real estate? Well, yeah, you want to risk, losing your house, but gold and silver are usually the alternative investment, so to speak, and they're usually not very well liked for a couple of reasons. Number one is they don't provide a yield. They don't provide cash flow, and on top of that, they don't appreciate as quickly as some of the other asset classes. Now, that can be argued, for the last couple of years, and that's perfectly fine. You can make your argument then. But basically, bottom line is gold and silver are kind of like the bottom of the barrel. It's like, unless you got something else to invest in, you normally would not do it. Alright, and the last one is called capital appreciation. Basically, it's you wait for a run, and then all of a sudden everybody jumps on the bandwagon, and you get to sell your gold and silver at a higher price. Alright, so any of these four combinations, if you get one or two or three or four of them, you basically will get an unprecedented appreciation in price. Now, if you get one of them, it's enough to kind of weaken the price a little bit. And if you get none of them, well, basically you're looking at a 20-year bear market, which we did in 1980 to 2000. Now, on the supply side, we all know this for a fact. It's already well known that precious metals supply is limited. It's a fixed amount, meaning that you cannot produce any more gold and silver. Second thing is central banks cannot just magically make more gold or silver. But we do know for a fact that they hold gold as a reserve to back up somewhat their currency. Now, they're all fiat currencies right now, but central banks still hoard and still collect gold for some odd reason. Now, it shouldn't really matter, right? But they still do it. Now, silver, on the other hand, is kind of like called a bastard child. It used to be held by central banks, and it used to be minted for coins, but now it's kind of moved into the industrial metal and industrial products. So what we're really seeing with silver is that it's kind of like this in between gold and copper. Alright, bottom line is we're not seeing on the physical side a increased supply in any form. Now, who knows, maybe at $50, $60 silver, you're probably seeing more supply coming up, but as far as I know, and as far as the mines are concerned, we're looking at 5 or 7 year supply shortage in terms of silver. Now for gold, same idea. Now there's a lot of gold out there, so it's a lot more easy. It's a lot easier to dump the gold because so many people held it. But silver, on the other hand, it's being consumed, and there's still it's not really treated as a monetary metal, so to speak, even though it technically is. So it's kind of like this hybrid metal that we don't really see it perform as well as gold. Okay, so on to that. So where am I heading with this? So today, CBS Market Watch decided to throw out a reason for the decline, and let me just check my numbers here. But the actual gold fell about 2.5, 2.6 and change, while silver fell almost 4% on a better expected payrolls number. Okay, so let's talk a little bit about what this means. If you read through this, crappy article, which I like to say it's a crappy article because honestly, these people just don't know what else to type. They just kind of go ahead and make stuff up as they go. Basically, what happened was the payrolls number came out to 175,000 jobs created in May, from an expected of 164,000. Now, sure, it's an improvement. It's an improvement about 11,000 people. Now, what is interesting about this is because the payroll numbers were so good, the stock market rallied and the precious metals got a beating. Now, I don't know if it's coincidence. I don't know if there's a strong correlation, but when I see this type of thing, I really want to question whether there is a strong correlation. Now, what's interesting about it is that the unemployment numbers came out at 7.6, higher than the 7.5 from the previous level. So in reality, there was actually a higher unemployment number, yet the payroll numbers show a higher jobs. So the question is, what gives, right? My best guess is that on the payroll numbers, we're looking at either part-timers or we're looking at people who got the job at low wages, while the unemployment still includes people who are still looking for a job, maybe having given up. And in some cases, the numbers are still skewed either way. So the unemployment numbers pretty much kind of confirm that the economy is really not recovering as quickly as we expected. However, the expectation on it's so low, the bar is so low, people think of this as an economic recovery. Now, I'm not trying to be a cynic. I'm not trying to say that the economy is not going to recover, but what I'm trying to say is that this is a really poor numbers, poor data to really justify the drop in gold because, A, the economy is recovering. So anyway, the mantra here, and that's working, it's propaganda, is that as the numbers come in, it begins to solidify that the economy is recovering and that precious metals are no longer needed because fiat currency is doing what it's supposed to be doing, which is stimulating the economy. Basically what it is. Personally, I don't think this is a good enough reason for gold to drop. So in other ways, this is going to be another buying opportunity. Alright, so moving on to the last piece. The question now becomes is how are unemployment numbers or employment numbers and gold prices correlated? So if you really think about it from what I said earlier, and you really study gold and you study silver, and I've studied them for a while now, and I looked at the price action, there are two scenarios that allow gold and silver to move. And gold, like I said, is kind of like the dog, and silver you got the tail, and basically both markets dictate where they're going to go in terms of precious metals. The propaganda put by the news media, which I say propaganda because a lot of times you look at this and you're like, really? This is a reason why you guys say it's going to go up? Number one is that if unemployment is at 7.5%, that means that QE, according to Mr. Ben Bernanke, will continue, and I don't think it's going to happen overnight. So I think QE is still going to continue to the rest of the end of the year unless something drastic happens and you get more jobs coming in the next couple of months. But I don't really see that happening. The second thing is that old Alan Greenspan's right back at where he started, on top of talking about tapering QE. And it's funny about this guy is that he comes out during some of the, just to confirm the numbers. He came out a couple of hours ago, I think it was yesterday or earlier today, talking about how the Fed should taper. With his usual mumbo jumbo, talking about how interest rates, the $82 billion, $85 billion a month that should be kind of stopped. And what we're really seeing in the mortgage market right now is an increased interest rate. So we are seeing the Fed kind of taper some of that a little bit. but we haven't heard a strong commitment from Mr. Bernanke himself about stopping QE. So pretty much what the market's really banking on right now is two things. Number one, lower QE or stopping QE completely by the end of the year. They also factor in that the economy is recovering by looking at the payroll numbers. And if you look at the latest data, pretty much what they're trying to build a case for is a recovery by within the end of the year, or so far a stronger recovery than people expect. So, I don't know. I don't really buy that. I don't really buy that story just because I haven't heard anything concrete yet. At this point, it's all speculation. Now, the real correlation really is, and I really want to see this happen, is a permanent rate hike. Not this kind of speculative if the Fed is going to increase rates, if they're going to taper the QE, maybe if the employment numbers are going to go up. I don't want to hear that. What I want to hear is a strong commitment from the Federal Reserve saying that interest rates are going to go up, and they're going to go up to curb inflation and also to make sure that the economy does respond correctly. Second thing is we want to see a permanent reduction in the money supply. I'm not talking about a contraction or permanent contraction, but I'm trying to see either commitment to stop deficit spending, to start cutting expenses across the board, which they've already addressed on some level, but we want to see that M3 come down a little more, especially in the credit area. And the Fed hasn't really talked about that. I mean, they've pretty much have their base currencies, and they're still lending to these banks, but they haven't really said anything about lowering the amount of money that's put out, or reining in the existing money that was put out since these last 3 years. The third one is, what's interesting is that even if they do increase the rate hikes, we still have the problem with the reserve rates. A lot of banks right now have a very low reserve requirements, and they went after the stress test, and the Fed said they were fine. And a lot of these banks are hoarding this cash, and they're just kind of passing it over to the Fed and making some money off of it. But until we see a higher reserve rate, we're not going to see really a contraction in that money supply. And I don't think the Fed wants to do that because then it's going to lead into a deflationary environment. So they got a catch-22 problem here, and they're going to have to really solve it within the next couple of months. The fourth one is that we want to see a commitment of QE later this year. Now, either that's a written statement, or that's a public statement, or that's going to be something that we look at the numbers, and if completely stop QE, then we might consider the fact that maybe the precious metals are going to stay at these levels. And the last one is a commitment to deficit reduction. What we want to see is basically strong commitment from Congress to say that we're not going to be spending more above than what we have right now at this point. And I think earlier this year they had that conversation about the debt ceiling. Now, as long as the deficit keeps on increasing and debt to GDP ratio keeps on increasing every year, we're going to have a problem paying that in interest. And there is no real solution to that unless the debt gets paid. But at the same time, if we pay off that debt, we end up being we contract the money supply, and then we go down the road of a deflationary environment. So anyway, bottom line, what I'm trying to say is these people have to be a little more creative. And these are the 5 things I'm looking for, and not really seeing that. All I'm seeing is that unemployment numbers are up, but who knows what that could mean. It could mean, it was a great month just this year around it. It could be that, they've hired more people on the minimum wage, or maybe some people just gave up looking and went ahead and settled for these crappy jobs that are out there. So, bottom line, hold on to your gold and silver. Hold on to these prices. They're going to go down as the public reacts to this and digests this information over the weekend. Probably next week we're probably going to see a little more selling pressure. But eventually what's going to happen, and eventually the markets will find a way, is that the silver and the gold prices will appreciate unless we have some sort of solid commitment to reducing this problem that we have right now. So anyway, silver today hit, like I said, it went back to the April low, which was at 2080, and I believe now it's, I think the low is 2050, I believe. Apologize for that. And so we're going to watch this $20 level really carefully, because that last one, we found a lot of buyers, and it just kind of snapped back up. So if it kind of lingers around this $20 area, expect it to go down to 18. And remember, I told you before, all my viewers, If it hits 18, we're looking at a floor of 18, so that's going to be the very strong support line. Once you hit at 18, you really want to increase another position in there, because what's going to happen is we're going to wash out all these weak holders, and then what's going to happen is the price is going to kind of drift a little bit sideways, and then we're going to get a nice snapback rally. So we're getting really close. You're just going to have to watch the price, watch the action on the physical side, and watch the side on the paper, on the gold prices. But my prediction, and usually if I were to make one prediction, I expect silver to go down 18 first. I expect it to kind of linger around, maybe even dip a little lower, a buck or two, 16, 17. I don't think it's going to go any lower than that. Don't quote on me, but what's going to happen is they're going to continue with QE, and basically they're going to manipulate these numbers all they want, and then we're going to see a real expansion in the currency next year. So stay strong, hang tight, and keep on stacking.